In the Indian financial sector, traditional lending often moves at the speed of paper. It is a system defined by physical banking infrastructure, making credit slow to reach millions who need it, and difficult for institutions to scale safely. Bajaj Finance moved past these constraints by digitizing the entire process, allowing them to grow their assets under management to more than 5 lakh crore rupees. This growth raises a massive question for the next decade. Can this company maintain its trajectory to become India's next 20 lakh crore financial giant? To find the answer, we have to look past the capital and investigate the proprietary technological machine that the company has built over the last 2 decades. Bajaj Finance is attempting to engineer a new scale of lending in India, replacing manual intervention with automated, high-velocity credit systems. The foundational engine is interest income. Bajaj routes capital to consumers for everyday purchases, like mobile phones and cars, and collects interest as loans are repaid. These margins are bolstered by secondary streams, including processing fees, insurance, and investment products. This operation spans thousands of physical branches and partner stores, linking urban hubs and rural villages into a single digital ecosystem. The strength of this business lies in a combination of decades of proprietary customer data and a massive integrated merchant network that competitors find difficult to replicate. Bajaj uses this data to power AI-driven credit scoring engines, allowing them to evaluate a borrower's risk and approve a loan almost instantly. This creates a data flywheel. Every successful repayment adds a new data point to the system, making the next loan decision more accurate and more profitable. The latest Q4 results suggest this flywheel is functioning efficiently. Despite a challenging economic environment, profit after tax continued to rise, while the relative cost of credit trended downward. These results were driven by 2 main factors: an improvement in overall asset quality and a steady influx of new customers into the ecosystem. To accelerate this, management is moving toward total AI integration across their entire operation. They are deploying autonomous models to handle underwriting, customer service, and even collections, aiming to remove human friction from the lending cycle. If successful, this integration will shift Bajaj from a traditional lender into a high-efficiency technology platform that can manage millions of individual loans with minimal overhead. These operational shifts are currently reflected in the stock's market performance and technical structure. On the long-term chart, Bajaj Finance remains in a clear uptrend, finding support at its moving averages. Currently in a consolidation phase, the price moves sideways while the relative strength index resets to neutral, showing improved relative strength. Historically, when strong compounding fundamentals meet this exact kind of technical consolidation, it often precedes a significant move higher. However, rapid scaling in the financial sector comes with inherent systemic risks that no institution is entirely immune to. A large portion of the portfolio consists of unsecured lending. In a sharp economic slowdown, borrowers without collateral are often the most vulnerable to default. Furthermore, sudden regulatory changes or a prolonged high interest rate environment could cause a spike in non-performing assets across the book. Bajaj attempts to mitigate these risks through disciplined risk controls and by maintaining a capital shield designed to absorb unexpected credit losses. Looking toward 2030, the company plans to diversify further, expanding its reach into digital payments and wealth management to drive the next leg of growth. Bajaj Finance has built its lending business on a foundation of data and automated execution. If it continues to manage its credit risks while scaling its technology, it remains positioned to compound its earnings as a central player in India's financial future.